America didn't conquer the world with tanks. It did it with something far more powerful, and it happened so quietly. Most countries volunteered. How do nations volunteer to give up financial sovereignty? In 1944, the world was exhausted. 2 world wars in a single generation had shattered Europe. Empires collapsed. Currencies were unstable. Trade had broken down. Entire economies were operating on ration books and emergency printing presses. But while Europe was burning, the United States was ascending. Its factories were intact. Its industrial output had doubled. It held nearly 2/3 of the world's official gold reserves. Its military was dominant. Its debt was high, but its economy was even stronger. And inside a secluded resort in New Hampshire, something historic was unfolding. Delegates from 44 allied nations gathered at the Bretton Woods Conference. The official goal was stability. The real outcome was structural power. Let's pause here. Most people imagine global dominance happening through war, invasion, or territorial conquest. But financial dominance, that's different. It's quieter. At Bretton Woods, the United States proposed a new global monetary system. The US dollar would be convertible to gold at $35 per ounce. Other major currencies would peg themselves to the dollar. This meant the dollar became the anchor. Gold sat at the top. The dollar was tied to gold. Every other currency was tied to the dollar. It was a pyramid, and the United States was at the center. 2 major institutions were also created. International Monetary Fund, World Bank, both headquartered in Washington, D.C. Now ask yourself something. If your currency becomes the foundation of global trade, if global financial institutions operate from your capital, if your economy is the largest and most productive, are you simply participating in the system, or are you shaping it? This wasn't accidental. American negotiators understood something profound. If you control liquidity during crisis, you influence policy. The IMF would lend to struggling countries, often with conditions. The World Bank would finance reconstruction, shaping development priorities, and the dollar would sit at the center of it all. But here's the subtle genius. At first, this system genuinely worked. Europe rebuilt under the Marshall Plan. Trade expanded. Currency stability returned. The United States acted as a lender of last resort, and trust is the foundation of any monetary system. But systems evolve, and what began as stability would slowly transform into something more strategic. Because once the world builds around your currency, switching becomes nearly impossible. By the late 1960s, cracks were forming. The United States was spending heavily on social programs and the Vietnam War. Dollars were flowing overseas. Foreign governments were accumulating large dollar reserves. Then they asked the obvious question. If the dollar is backed by gold, can we exchange our dollars for gold? They could, and they did. Gold began leaving U.S. reserves. Confidence wavered. On August 15, 1971, President Richard Nixon made a decision that changed global finance forever. He suspended the dollar's convertibility into gold. This moment became known as the Nixon Shock. In one speech, the dollar transformed from a gold-backed currency into pure fiat, backed only by government authority and global trust. Now here's the part that should surprise you. The world didn't abandon the dollar. It kept using it. Why? Because by 1971, the dollar was embedded into trade contracts, central bank reserves, international loans, and global banking systems. Replacing it would have caused chaos. It was like trying to remove the engine from a plane mid-flight. And then came the next strategic layer. In the 1970s, the U.S. reached agreements with Saudi Arabia and other OPEC nations. Oil, the lifeblood of industrial economies, would be priced exclusively in U.S. dollars. This became known as the petrodollar system. If you wanted oil, you needed dollars. That meant countries had to hold dollar reserves. They had to trade with the United States, or they had to borrow dollars. Suddenly, global demand for the dollar wasn't about gold. It was about energy, and energy is non-negotiable. This created a self-reinforcing cycle. The world needed dollars, gives the U.S. could issue debt gives. Foreign countries bought that debt, gives the dollar remained dominant. Pause for a moment. Imagine being able to borrow in your own currency and having the world line up to lend to you. That is structural leverage. This is when quiet control solidified. Not through threats, not through coercion, but through integration. The dollar became the default reserve currency. Central banks held it, corporations borrowed in it, commodities were priced in it, trade cleared in it. And when crises hit, from Latin America in the 1980s to Asia in 1997, the IMF stepped in, with loans, with conditions, with influence, and because the IMF operates largely in dollars, the architecture reinforced itself. By the early 2000s, the global financial system was deeply interconnected. Dollar-denominated debt spread across emerging markets. Wall Street investment banks expanded globally. U.S. Treasury bonds became the safest asset on earth. Then came 2008. The U.S. housing market collapsed. Banks failed. Credit markets froze. The crisis started in America. But it didn't stay there. European banks holding U.S. mortgage-backed securities suffered. Asian exporters saw demand evaporate. Emerging markets faced capital flight because the system was dollar-based. When the dollar system trembled, the world trembled. But here's the paradox. During the crisis, investors fled to U.S. Treasury bonds. They ran toward the dollar. Fear strengthened the very system that caused the instability. That's financial gravity. And this gravity extends beyond markets. The global payment network known as SWIFT plays a critical role. While headquartered in Belgium, dollar transactions typically clear through U.S. banks. This gives American regulators immense visibility. It also gives Washington a powerful geopolitical tool. Financial sanctions. If a country or institution is cut off from dollar clearing, its ability to participate in global trade shrinks dramatically. This is not theoretical. It has been applied multiple times in modern history. Now here's a pattern interrupt. When most people think of power, they picture aircraft carriers. But in the 21st century, sometimes power looks like a spreadsheet, or a compliance notice, or a frozen bank account. Not dramatic, but devastatingly effective. This is the culmination of decades of structural positioning. America doesn't need to force countries to use the dollar. The system encourages it. Global trade networks are priced in dollars. Debt markets are denominated in dollars. Central bank reserves are heavily dollar-weighted. It's the path of least resistance. But no system is permanent. In recent years, discussions of de-dollarization have increased. Some countries explore alternative settlement systems, regional trade blocs, experiment with local currency agreements. Digital currencies emerge as potential disruptors. Here's the cliffhanger. Is this the beginning of the dollar's decline, or simply noise in a system too large to dismantle? Because unwinding dollar dominance would require replacing global reserve assets, rebuilding financial infrastructure, convincing markets to trust a new anchor. Trust is slow to build, fast to lose, but incredibly hard to transfer. And here's the deeper truth. America's financial dominance is not just about currency, it's about liquidity. The U.S. Treasury market is the deepest and most liquid bond market in the world. During crises, investors need safe, liquid assets. There are few alternatives at that scale. This gives the United States extraordinary resilience, but resilience is not immunity. High national debt, rising geopolitical tensions, technological disruption, political polarization, these factors test confidence, and confidence is everything. History reminds us that reserve currencies rise and fall. The British pound once ruled global trade during the 19th century, but after 2 world wars weakened Britain economically, the dollar replaced it. Not overnight, gradually, structurally. The same way America built its position. Which brings us to the central insight. The United States did not take control in a dramatic act. It architected a system, step by step. Anchor currency in 1944. Institutional influence through the IMF and World Bank. Fiat flexibility after 1971. Energy reinforcement via the petrodollar, deep capital markets, global payment infrastructure, sanctions leverage. Each layer strengthened the next. Each crisis reinforced centrality. Each decade deepened integration. And most Americans never noticed, because structural power feels normal until it's challenged. So here is the question that matters most. If the dollar underpins global trade, if U.S. debt finances global reserves, if American interest rates influence worldwide borrowing costs, what happens if confidence falters? Would alternatives rise? Would global finance fragment? Or would the system adapt, once again reinforcing its core? That is the real story unfolding today. Not loud, not dramatic, but structural. And structural shifts are the ones that reshape history. Understanding how America quietly took control of the global financial system is not about conspiracy. It's about incentives. It's about timing. It's about leverage. In 1944, the U.S. offered stability. In 1971, it offered flexibility. In the 1970s, it secured energy alignment. In the decades that followed, it deepened liquidity and institutional reach. The world opted in because it worked, because it was efficient, because it was stable, and because alternatives were weaker. But the future is not guaranteed. Dominance requires trust. Trust requires discipline. And discipline requires long-term thinking. The next chapter of global finance will test whether this architecture remains central or evolves into something multipolar. That transition, if it happens, will not occur in a single headline. It will unfold slowly, structurally, just like the rise did. If this deep dive reshaped how you understand global power, then you need to watch the next video on your screen. In that breakdown, we examine the emerging forces that could challenge dollar dominance and what that means for America's economic future. Because history explains the system. But the future, that's where the real leverage lies. I'll see you in the next one.